In this lecture we are going to be looking at an advanced example of a double market manipulation in the Australian dollar versus the Japanese yen 15-minute timeframe. What happens in this particular example is not what you will find most of the time in the market, but it is certainly useful to study these more complicated scenarios, so we can have a better grasp of how far these manipulations can really go. I will throw some exotic line studies as well, so you can see the underlying symmetry of the market. As usual, we begin the analysis by picking a relatively comfortable amount of price information in the chart, which is something between 100 and 200 candles, I would say. There are two reasons for that. The first reason is that we need to be able to see the details of price well enough, and the second reason is that price action has a short memory, so it doesn't seem to care about what happened too far in the relative past of the timeframe you will be trading. The very next step is to count the most important highs and lows in the chart because they are the axes that will form our analysis, so to speak. Between numbers 1 and 5 there is not much going on in this market other than the undeniable fact that sellers are producing lower highs and lower lows. This is what we call the natural flow of price action. There is no manipulation nor any type of market intervention whatsoever. There is just the natural swinging motion of price action. This market starts to twist around number 6 onwards. Observe that high number 4 is the last solid market structure up to that point, and high number 6 lightly pokes it. In a situation like this, a light poke cannot be considered a large trader's attempt to create a deep liquidity pool. When we have a small poke like that, we tend to ignore it because we have something called market noise. You will see what a real stop hunting candle tail looks like in just a moment. After candle 6, price starts to fall, and our downtrend hasn't yet been taken down. All the solid sellers' structures are intact. This seems to be good news for you if you are a retail trader because you have a very clear goal for what your next trade will be at this point, which is the low number 5. Since price is going down, retail traders will attempt to place a sell stop order at low number 5 thinking that the natural momentum of price will drive their positions to profitable territory. As price approaches the low number 5, observe that it starts to accelerate. As you might be getting used to at this point, this is done on purpose by the large traders, and we can see that's the case by observing how this acceleration occurs in an organized manner, meaning that each candle that passes by creates a lower high and a lower low as it is marked by the series of red arrows. This is the von Restorff effect in the first manipulation in this chart. In candle number 7, the large traders pierce low number 5 with a significant degree of violence to trigger the cluster of sell orders, and therefore, create a deep liquidity pool for the exact opposite side. In other words, as soon as the deep liquidity pool is created, large traders enter massive long positions. This is usually the way the large traders sneak in these massive positions in the market without grabbing too much attention. The lower tail of candle 7 is a signature of that. If you wanted to take advantage of this manipulation at this time, you could use the horizontal line that comes out of number 5 as a wash line. Observe that in candle number 8, price comes back to the wash line for a brief moment, and then it shoots up. For you to take advantage of that in real time you would have to be a really good trader. This type of trade is among one of the most advanced and subtle types you can do in the market, but as you can see, there is logic to it. The other two legs of the first manipulation occur in the lower to mid portion of the candle 8. Once again, the process is exactly the same. Retail traders become desperate because their short positions are being stopped out, and they begin assuming the opposite position to attempt a quick recovery. Let's not forget that by the time this happens, large traders are already in the market, so anyone that enters a long position is actually helping the large traders. That would be the reverse psychology of a market manipulation, meaning that retail traders are purposefully triggered to one side of the market with the sole purpose of being triggered to the opposite side of the market right after. In case if you're wondering why this is necessary, just remember that for large traders to open big positions, they need deep liquidity pools, and they can only do that by whipping other traders. Candle number 8 also shows the bandwagon effect, which also happens to work in favor of the large trader's position. The problem for retail traders at these stages is that they don't hold their positions long enough. They close their trades as soon as they see profit in the terminal. This is a case of hyperbolic discounting, and it's one of the reasons why they keep being whipped around like that time after time. Now it's where the rest of the fun begins in this chart because market makers are preparing themselves to do the exact same process once again. That's why I called this a double manipulation. These two manipulative maneuvers are intertwined because the bandwagon effect of the first one is the von Restorff effect of the second manipulation. The process is exactly the same, but now the retail traders are after high number 6. When they look at candle 8, they think the market will definitely rise if price breaks high number 6. In candle 9, the exact same process that happened in candle 7 occurs again, but this time it's mirrored, of course. You might be asking why large traders would do a double manipulation like that, and there is just one possible answer to this, which is to attempt entering an even larger position that was entered in the first manipulation maneuver. Remember that in number 9, large traders are still carrying a large long position. In number 9, they poke the long orders of retail traders to create the opportunity for them to sell, and at the same time, they have themselves a large long position they can dump as well. The end result of this is a short position even larger than the long position that resulted from the first manipulation. You can think about this second manipulation as a way of increasing the size of the first manipulation. The direction of the market is irrelevant since they can control that to a certain degree. The trade you see in this chart is actually a prelude to the next course about pitchforks and Newtonian physics in the market. What I want to do here is to grab your attention to some of the symmetries we can find in price action, and how we can use these symmetries to find trades using the market manipulation we discussed here as the surrounding context. Observe that I have a downward pitchfork drawn in the chart. This fork was drawn using the two central axes of both manipulations, and the immediately previous significant high. The reasons for this divide themselves into self-evident and non-obvious. They are self-evident because we are using obvious extremes with clear importance in the chart, and they are non-obvious because we haven't yet seen why we must draw pitchforks in such a way. That will come in future courses. The main thing you need to understand is that one of the uses of a pitchfork like that is to pinpoint the absolute edges of the market. After number 9, we see price fall down a bit, so it's logical to wait for price to bump up again to give us an opportunity to enter the market in alignment with the large trader's short position. A pitchfork is a dynamic line that can pinpoint with crazy precision the level in which price will reverse. That's exactly the trade you see here in this chart. I entered the short position exactly when price touched the upper line of the pitchfork. Before you open your charts to see how well this idea works, keep in mind that this specific fork in this specific situation only works because we drew it in the correct place and in the correct time. In other words, I drew it in the correct context of the market manipulation. The stop loss was placed above high number 9. The target was placed at low number 7, which gives us a perfect 1-to-3 risk-reward ratio trade. Let's see how the market plays out. As you can see here, our trade idea was successful. Pay attention to how price behaves around the blue fork. The manipulation maneuvers that we identified gave birth to a fork that was able to bring out the underlying symmetry of this market. There is no other way of seeing these lines. We will study these things in great length in the next course.